Tony Delaney, CEO of SYS Wealth and Financial Planners. Pensions has become a very topical subject over the last number of years, and to be fair to say, I think it has got a little bit of unfair, bad publicity, maybe because what has happened in markets, over the last number of years. In particular, I think we're still carrying a lot of the baggage from the 08 financial crisis. But I do believe that we, as an industry, we have made pensions a little bit more complex than what they need to be. And I suppose what we say to our clients is, look, pensions can be as complex as you want them to be. But for example, if you're a sole trader, you have a personal pension. Or if you're a company, you can fund completely different. There's different, I suppose, for example, if you're 40 years of age, you can only put in 20% of your salary. But as a company director, you can do max funding. And it has a lot more, options than being self-employed. The options at retirement can be the same, but you can just extract way more money out of the company under company pension tax-free. So I have a simple rule of thumb. If you're working for an employer and you have 20 years service, under revenue rules, you're entitled to 1.5 times your salary at normal retirement age, tax-free. So when I say to any client I meet, if you're an employee of Joe Bloggs Limited and your salary is 40 grand and you retire, the worst scenario is you should have 60,000 in your pot, pension pot, and extract that tax-free the day you retire. That is your worst scenario. But a lot of clients that I've dealt with over the years, and I don't mean to be picky in the low, because some of them aren't actually always in the lower paid, but people sell you pensions on getting tax relief. But when we meet our clients, it becomes way more advisory. And when I mean advisory is we look at your current situation and we look at where you're going to be at retirement and in post-retirement. And a lot of people fall into this category where if you're a married couple, for instance, with one retired at age 65, you can earn 36,000 a year and pay no tax. The state pension is currently brought back to 66. Likelihood it'll go back out to 68. The government can't afford to stay paying the state benefits. But if you were 65 today and you happen to be, or 66 and you happen to be in receipt of the state pension, a married couple, if you qualified for the full amount, you're getting a little under 26,000. But you actually have a shortfall in your income of 12,000. So the best way to, if you've no other assets or say property that you're getting an income from, a lot of people fall into this category. The best way is to fund that is through a pension. So a very quick example would be for someone in that situation, they could actually target a fund roughly of 400,000, get out 25% tax-free, which is 100,000, and get an income of 12,000 a year from the remaining pot of 4% per annum. Now there's a word for that, but without going into the terminology of it, it's another pension vehicle. So 4% is 12 grand a year, and 25 just brings you up over the 36,000. You'll probably pay 400 or 500 euros tax. That couple could have been paying high tax or low tax all their lives. And the average person now is going to live till probably 86 or 87. And they haven't done proper retirement planning. I'm not even using the word pension planning, retirement planning to bring them into that category. And there's a lot of people that are falling into the middle earned income earners are falling into that category. And it's just lack of proper advice and understanding about, pensions. So for me, there's a lot more education needed going forward for people around pensions in general. But they are a very tax efficient vehicle, and currently probably the best tax efficient vehicle that's available to most people in the Irish marketplace. So it's either 20% or 40% tax relief. You get some out tax free. You could pay tax on some of your income, or you might pay no tax. But that's where the advisory part comes in, and we need to wind on the clock. That if a client is 50 today, if you were 65 today, what likely would be, based on your current situation, could your tax implications be? So for us, retiring tax efficient, planning tax efficiently, and maybe even looking at staggering your retirement rather than having one pension. So again, we do not know this until we sit down with every client, and I call it bespoke advice to every individual. And the process will be the same, what we follow, but each time the advice is different because people have different objectives in life. Married, single, people don't like talking about debt, but what happens on debt? If you're not married, is there tax implications for your spouse, or if you have children, there's not. But we go into that level of detail, and even down to, making sure that is your will tax efficient. So when I talk about pensions, it's just not about that. That's one part of the process. I believe that's sort of only dealing with one part of the jigsaw. I look at financial planning as a jigsaw. We mightn't get it all fixed today, but once we know where all the moving parts are, we can eventually put it together. And for me, I call that integrated advice rather than isolated advice. Because if I just specifically talk about that pension, I'm not looking at the bigger picture, and maybe maybe the client is not receiving what I call the best analysis or overview of their current financial situation to build them a proper financial plan into their future. I mentioned isolated advice and integrated advice, and I looked at this over a number of years ago in my previous life, and we went out and we met clients, and you look at sort of to have a life policy, to have maybe a specific illness policy, and have a pension or an investment, but sometimes they look, Tony, I want to talk to you over a pension or life cover. And you'd say, oh yeah, we'll deal with that. And we end up maybe setting up a pension or something like that. That might not be what the best needs for the client. So I call that isolated advice. So when we meet our clients today, I say to clients at the very outset, it's like starting with a blank page. You need to give me all the information, provide me of your current financial situation. Let it be paid up pensions, existing pensions, life cover, your income, your assets, the age profile of your children, when you're planning on retiring. When we get the overall picture and we map that together, and as I mentioned, it's like a jigsaw, that becomes integrated advice, not isolated advice. And I call isolated advice really selling a product to the consumer. And that's not where we have pitched ourselves in the financial services space. We have now become very, very much advisory. And I think that is becoming more important going forward. And we believe integrated advice is the only way forward for clients to get the right financial plan, to put them on the right financial journey to protect themselves and their loved ones throughout their lifetime.